Hi everyone, my name is Saleh, founder of Saleh Property Investment. I hope you're well and safe. Okay. Well, today we're going to talk about how to self-assess your personal cash flow statement. So we will break down into subtopics, and the timeprints for all of these subtopics will be provided in the description below should you wish to fast forward. So we will discuss what is cash flow, why is it important, what the bottom 80% do, and what the top 20% do. Okay, so now why or what is cash flow? Cash flow is literally an income coming in and literally an income leaving from your account, so which is called expense, or how you receive. So I'm going to go in a bit more detail and demonstrate onto the paper and pen in a little bit. Okay, so that's one, what is cash flow? Now, why is it important? Okay, now, why is it important for you to take an inventory of yourself? Okay, right now, post COVID-19 crisis, is literally to take a closer look. A starting point is for you to take a closer look of your personal statement, okay, and where the cash is flowing. Okay, so you will see your income coming in right at the top. Okay? Key fundamentals or a basic financial statement is income, okay, expense, assets and liability. I will go in more details again. I'll demonstrate what these terminologies are if you're not familiar. Most common source of income will be your wages, okay? That's our salary coming from our employer, okay? And pension distribution, okay? Or even unemployment income. Whatever the type of your income, this will go at the top of your financial statement. Now let's take a look. Now let me demonstrate in a closer look of your income statement might look like. For example, most of the people, they would have an income that's coming in from their wages, or it could be from pension, for example. So wages is literally a salary that's been paid from your employer to you. Okay, now your expenses automatically tax has been deducted, unless you're a self-employed where you'll be declaring your tax at the end of the financial year. So you'll be paying transport, you'll be paying your bills. For example, bills that consist utilities and etc. You'll be paying for your groceries, and you'll be paying for rent. Okay, so rent is fixed cost, for example, and bills is your variable cost. Transport, it could become a variable cost depending on how you travel. So some days you might be cycling to work depending on the weather, or some days where you will be walking to work, or you'll be taking different method of transports. Okay, so now to understand again, to recap, income is literally money coming into your statement. Expense is money leaving your account, your statement. Okay, so now if we drop down to asset, so most common mistake where people tend to think is that a house, if I can draw it correctly, a house is an asset. Well, that depends, because house could become a liability too, and I will explain in a little bit more detail. Okay, a house, it can become an asset or a liability. Why is it liability or an asset? That depends on which side of the table that you're sitting on. For example, most of the real estates, they tend to say your house is automatically an asset. No, a house is a liability if you're living in it yourself. Is an asset to the lender, for example, your bank who has lent you for your mortgage. That's an asset to them, but it's not an asset to you. Why is it an asset to you? Because you'll be paying monthly mortgage fees towards them. You'll be paying insurance, maintenance. So that's taking money out of your pocket and is leaving through the expense. So money came in through the wages, it went to here, liability, and then it went to your expense. So money came out. So that's one method. Okay. But the same house, for example, if you are renting this out and you are not living in it, so this will generate you a revenue that becomes an income. So is an asset in that sense, yes. Okay. If you're renting like HMO, house of multiple occupants, or for example, if you are renting to students, or a family house, okay, so that's a monthly income that's generated from your property. Another example, it's a car, a vehicle, okay, so I'm not going to draw a car here, I'm just going to write a car, okay. This is both asset and liability. Why is an asset and why is a liability? I'll explain that in a bit more detail. Okay, now let's go start with liability. Why is a liability? If you're using this car now for your social needs, the car needs maintenance. Okay, so that's money coming out again, going to the expense side. You'll be paying for insurance, tax, fuel. So that's all already consuming. So that's taking money from your pocket and is going out of your pocket. So now the same car, if you were renting out, for example, or if you're using this car as a taxi, this will generate an income and this will go to your income statement as a money coming in. So that's an asset in that sense. Yes, the car depreciates in both sides, but this is definitely a liability and this is something that we are trying to avoid. So now if you take a closer look of your statement, you would see a lot of things that you have there are not necessary. For example, you might find it necessary, but in other sense, people might not see it as necessary. If you're paying, for example, and this is perfectly fine if you are, Netflix, if you have things, subscriptions that are, you're not actually using it, utilizing to the full of its capacity, it's not a necessity, so you could reduce that. And now a lot of self-employed people, they would go and check their statement at the end of the year and declare that and see how much tax that they need to pay. So now this is things that you need to start taking an inventory of. Start thinking now, look at the past 6 months if you can, okay, and see where you can save cost. Okay, you could save cost from variable. You can't save cost from fixed cost, okay, because fixed cost is fixed. Okay, things fixed costs are rent, for example. You can't reduce that. The rent is fixed. Right, now that we understood what a financial cash flow is, we will take a closer look, or actually show you, okay, what literally the basic fundamental of key financials literally is, okay? So now, once you understood that again, we will take a little bit further on how self-employed and small business, how they work and how they could potentially move on to the top 20%. Okay, so now I'm going to show you what the 80% literally do first. Okay, so now potentially 80% of the population, okay, that's 80% of the population, they're older, they will either continue to work to make money for living, or they will either depend on the government or on their families to subsidize their lifestyle. That's 80%. Think about it, 80%. Okay, some of you are thinking that of yourself that you might better be successful. Okay, the remaining top 20% are either generational wealth or a self-made millionaire. Okay, so now let's take a bit more zoomed in, like through the lens. Okay, that what the most mistakes that the common people do. Right, what average 80% people do are basically once they receive their income, it goes straight to their personal account. And this is literally, I'm just going to give you a snapshot of a self-employed person who gets paid and it goes to his personal account. But now this, for example, let's just use a figure, for example, of 10,000. Now this person spends rent, bills in terms of utility, transport, maintenance, grocery, and other social needs. Okay, like going dinner or going for a holiday. It's just having a good time. Okay, so this is a self-employed, and this is what the basic average people do. Now I'm gonna show you here at the bottom what the top 20 people do. Okay, the top 20, they get checks. Okay, have you noticed the subtle change? So this person gets check and this person gets checks. Now when the checks comes in, it goes into business account. Okay, and then they have a tax account. Okay, they have business expense account. Okay, and then they have home account, which is also known as personal account. Now let's just use again the same amount, 10,000. So straight away what the top 20 people do is that they would put 3,300 aside for tax. They would put 3,300 or less to their business expense account, and then they would put 3,400 to their personal account. Yes, this 3,400 lifestyle. Okay, now the difference between the bottom 80 and the top 20 is that it's the same amount, but they invest first. Okay, and then they use the remaining for their personal needs. But with the bottom 80, what they do is they use everything for their personal needs, and then the remaining, and that's what they invest. And most cases is that you'll be left with very minimal or nothing. Okay, so I think you should apply this strategy in your financial statement and then see how you can save money.